Welcome to the Credit Compass, helping you navigate the world of European credit, where we break down the biggest moves in credit markets, macro trends, and fixed income strategies, shaping the financial landscape in Europe and the UK. In this episode, we will cover the recent pause in tariffs and what they mean for Europe. It is worthwhile taking a breath and reassessing where you stand with regards to worst and best case scenarios. Despite where we end up at the end of 90 days, given the past 90, we can expect a considerable amount of volatility. We will also touch on how investors can take advantage of the current pause to reassess where they stand going forward. In our view, it is worthwhile paying attention to what your investments have to say about the coming quarters. And it will be something that we will be looking at over the next few weeks as companies start to report their first quarter earnings. All right, let's dig in. First up, the pause. Tariffs, or at least some of them, have been delayed for 90 days. As my colleague Van Hesser has commented on in his podcast, Three Things in Credit, the guardrails have been triggered and a number of voices have come to the rescue to support the pause. This will at least put some time in front of the markets to allow everyone to digest the potential impact of the originally unvetted, at least by the market, tariff rates imposed on the 2nd of April. One influential voice that entered the fray was that of Howard Marks, longtime investor and co-founder of Oaktree Capital Management. He drew a parallel between the U.S. administration's tariff policies and the UK's Brexit decision. He described the tariffs as an own goal. To quote Mr. Marks, they are highly analogous to Brexit, and we know how that turned out. Declines in GDP, shaken morale, weakened alliances, and a damaged reputation for the governance, all self-inflicted. He emphasized that while the intentions behind tariffs, such as supporting domestic manufacturing and reducing trade deficits, might be commendable, the real-world outcomes could be detrimental if not carefully managed. We would argue that while we do agree that Brexit has been a challenge to the UK growth over the past number of years, this episode is a little bit more like the Liz Truss government mini-budget than Brexit when comparing it to the UK. The impact of the Liz Truss government mini-budget. We would argue that while we do agree that Brexit has been a challenge to UK growth over the past number of years, this episode, when comparing it to the UK, is a bit more like the Liz Truss government mini-budget than Brexit, when the bond market bit back on her government's unvetted policies. What do I mean by unvetted? Well, normally when a government is considering implementing a new policy, particularly one that could be controversial, there are experts with which one consults and are theoretically independent of party politics, such as a central bank or in the UK, the Office for Budget Responsibility, or others, in order to minimize the negative consequences. There are even typically some backroom channels where discussions can take place with key figures in business and the media to determine how they may or may not land with the public and the markets. In the case of the Liz Truss government, little was done to determine how she was going to afford to do what her government was planning. However bold or ambitious she might have been, the impact on the budget was not given the consideration of the bond market views. And the bond vigilantes, as they are known, sent a message, pushing bond yields higher. Now, for the UK example, there was the unfortunate consequence of the fact that the bond market reaction broke a small section of the pensions market. Liability-driven investing, or LDI, caused pension funds to urgently raise cash as the UK bond market sold off, and the funds needed to raise cash to cover hedging created a perpetual sell-off until the Bank of England intervened. Let's hope the US bond market is more resilient than that demonstrated in the UK, and there aren't any hidden corners at risk of breaking. As Van pointed out on his podcast, private credit is also a useful guide rail and shock absorber for the system. A large degree of lending has migrated into the private credit and investment management market and away from the banks. The more long-term, patient capital that is not as influenced by market swings is able to absorb what would have materialized as liquidity pressure in the past and should help to absorb the current market volatility. However, that is not to say that it does not have consequences still, as was highlighted in our podcast last week. Take a listen back to the comments from KBRA DLD. Pause in tariffs will be helpful for markets to digest what is coming, and hopefully many countries will spend the 90 days negotiating improved terms over those initially proposed. Apparently, the UK and the US are close to arranging some sort of negotiated trade deal. We shall have to wait and see what materializes. But it is worth taking a breath and assessing the scale of the impact of these potential tariffs and what might impose upon European investors. I had a look at a couple of articles from some of the large investment houses recently, and they continue to espouse the positive value of fixed income in this environment. BlackRock has called it a golden age for credit. Amundi provided a useful look at what is expensive relative to historical levels. And for Amundi, the both ends of the risk spectrum stand out as good value in comparison to historical averages: European equities and European investment-grade credit. We couldn't agree more. Although, as a credit-focused firm, we would obviously prefer the investment-grade credit. And German investors, using the data from the latest ZEW Economic Sentiment Survey, are a little more negative in the recent month. Here, at the headline level, investors expressed a surprise strong decline in overall expectations. However, when we dig into the details, one can see that they remain more positive on the European markets over others around the globe. So now for the prepare part. While Europe may be viewed well by the market, investors should still look to take advantage of any sort of rallies to move up the credit spectrum into investment-grade credit, in our view, as the volatility is certainly not over. With that, what will we be watching over the next couple of weeks? Well, it's earnings season, so keeping an eye on what large European banks are saying about their loan loss provisions and any major changes will be important. We will also be keeping an eye on what companies are saying about their expectations for the quarters ahead. I suspect what we will see is actually a strong first quarter for many companies as orders and investment picked up ahead of the potential tariffs. And now many will be facing a quiet period while trying to second guess where things will fall out in 90 days, alongside some scenario planning. Here in Europe and the UK, we are currently sitting in a relatively positive position. European and UK governments have been woken up to the threat posed by increased tariffs, the need for reduced or improved regulations, and a need to improve defense. The European Central Bank does not have the same challenge as the Federal Reserve in the US, as inflation has already fallen to near target, and as a result, they will likely be cutting on Thursday. The Bank of England is also likely to cut, but it continues to face the challenge of high wage growth. Although job losses picked up in March ahead of the rise in labor costs next month with the increase in minimum wage and national insurance costs. That's all for today, and thanks again for tuning into the Credit Compass. Don't forget to like, subscribe, and share the podcast with colleagues and friends, and we look forward to speaking to you again soon. As always, staying informed is key to navigating the complexities of the markets today. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.